Welcome back. We're going to look at a practice problem from Chapter 3 in Accounting 1, Adjusting Entries. And this is the step in the accounting cycle after we have posted all our journal entries for the month and after we have created our unadjusted trial balance. We then go in and tweak the accounts, reclassify or take care of some timing issues that may have occurred during the month to get the balances up to date and ready to be presented in the financial statements. So this is a practice problem that we're going to look at with these 5 adjusting entries, and we'll go through them step by step, and hopefully will help you understand the adjusting process a little bit better. So in this example, we've got data that was accumulated for the accountant in preparing the adjusting entries for dependable realty. The first one deals with supplies. The supplies account balance on October 31st is $3,975. However, the supplies on hand are $1,050. So if we do not update this account, our balance on our balance sheet for supplies would be $3,975, and that's incorrect. We can't report that because that's not what we actually have. We only have $1,050 left. So we need to do an adjusting entry. The T account for supplies balance is $3,975, and that is a debit balance because that is the normal balance of supplies. We need the balance to be $1,050 because that's what is on hand. Okay, that's what we need it to be. How do we get there? Well, in order to reduce the supplies account, we credit that account, and we need to credit $29.25 from the supplies account to make the balance equal what we actually have on hand. So our journal entry, our adjusting journal entry, is going to be a debit to supplies expense for $29.25 and a credit to supplies for $29.25. That credit reduces the supplies account down to the balance of $1,050. The second journal entry deals with unearned rent. Unearned rent is a liability account. We owe rent to someone. We owe the service of rent. In this case, we are renting out maybe a piece of machinery or a building. We don't really know what it is, but we do know that our tenant paid us October 1st. They paid us $11,000, and that was a prepayment of 4 months worth of rent. So if we take the $11,000 and divide it by 4, that gives us $2,750 per month that they're giving us in rent. Now, October 1st, when we received that, the journal entry we did was we received cash of $11,000, and we put it in unearned rent. This was on October 1st. This is a liability. We owe that. We owe them that service. That we owe them the rent, the building or the tractor, $11,000 worth of rent on that, whatever they're renting from us. So on October 1st, we couldn't book this as revenue yet because we had not yet earned it. Now that we have earned it, we need to do a journal entry to move some of this, $2,750, 1/4 of it, into the revenue account. So if we had our T account for unearned rent, which is a liability, okay, liabilities increase on this side. We know that has $11,000 balance. That's what we did back on October 1st. We have used, or earned, I should say, $2,750 worth. That makes our balance $82.50. And this is what is left to be earned in the next 3 months. Okay, so over the next 3 months, we're going to take $27.50 each month out of this unearned rent account and switch it into a revenue account or a rent revenue account. So let's book this debit here. Let's book this journal entry. Our journal entry will be a debit to unearned rent for $27.50 and a credit to rent revenue for $27.50. Okay, that takes it out of unearned rent, puts it in to rent revenue. We're reclassifying that. If we were not to do this journal entry, this adjusting entry, if we didn't do it, we would be overstating our liabilities and we would be understating our revenue. And both of those are bad things. Okay, to overstate liabilities and understate revenue. We want to put all the revenue on our income statement that we have actually earned. And we've earned $2,750 worth of rent revenue from these tenants. All right, letter C, wages accrued but not paid at October 31st are $2,500. Okay, accrued. Remember I had the little rule with the R's? Accrued means earned or incurred. And in this case, we're talking about incurred wages. An expense has been incurred. And what this means is that our employees have worked, but we have not paid them. If we owe something and not paid it, it is called a liability. Okay, so we need to book a liability to increase liability with credit. And we also need to book an expense because we had an incurred expense here. And that would be a debit to wages expense. So to book that, debit wages expense, $2,500, and credit wages payable, $2,500. Now, this adds to the expense and also adds to the payable. Okay, a debit adds to expense, a credit adds to payable. There was really nothing, no trigger or no transaction that reminded us to post this. That's the tricky part with adjusting entries. You, as the accountant for the business, have to know these things. You have to know we have people working for us that we have not yet paid. And you will have that scenario just about every month. You know, how often do you get paid on the day that you earn the money? How often would you pay your employees on the exact day that they earn the money? Not very often. We usually get paid, say, on Friday for the week before. Or in my case, I get paid the very last day of the month for the month before. So there's a lot of timing differences, and we have to account for that. We want to book this on our income statement, this expense, because we did incur that expense. And we book this on our balance sheet because we do owe it. So although those are not good things to have, expenses and liabilities, we still have to report them because that's the correct information for our business. All right, letter D. Fees accrued but unbilled at October 31st are $4,900. Again, accrued means earned or incurred. So fees earned, it's a revenue account. Unbilled, what does that mean? That means they owe us. So if someone else owes us money, we call that a receivable. So we've got fees earned and accounts receivable. All right, let's just look here for a second and work through this. Draw our little rules here. Okay, fees earned and accounts receivable. Those are the two that we identified from that transaction. We have earned the fees, but we've not yet gotten paid. So we've done the work. We need that to show up on our income statement. Revenue follows this pattern. Fees earned is a revenue account. That's going to be our credit. So we're going to credit fees earned. Accounts receivable is an asset, and assets follow this pattern. Increase with a debit. Well, they owe us money. We need to increase that account balance to show that they owe us more than they used to. So that's going to be our debit. So let's go back and debit accounts receivable. $4,900. Accounts receivable, $4,900. Fees earned, $4,900. Okay, so this is putting accounts receivable on our balance sheet and fees earned on our income statement. We want to report all the activity of our business, whether we've been paid for it or not. We have not received payment from these customers, but that doesn't mean we can't just leave it off of our income statement. We want it to show on there so that we correctly reflect what we've been doing this month. And the last one is depreciation of office equipment, $1,100. Depreciation is the decrease in usefulness of an asset. We do this for all fixed assets. At the end of every period, we record depreciation and we put it into the contra asset account called accumulated depreciation. The entry for that is depreciation expense, a debit, and credit accumulated depreciation for $1,100. This is a contra asset account, meaning that it is an asset account, but it has a normal credit balance. So this increases the accumulated depreciation balance. The accumulated depreciation is deducted from the asset on the balance sheet to get the book value of the asset. So we don't take it out of the office equipment account. We always have to leave office equipment recorded at its cost. And if you think back to chapter 1, we had the cost concept, and that is the rule we have to follow when dealing with fixed assets. So the cost of the product or the asset will remain in that account, and then we have this other account that we use to keep up with how much we have depreciated so far during the life of that asset.